I want our listeners to get a lot of value and our viewers.
Mm-hmm.
How do we make money? How do we make money with our money?
Yeah. Yeah. Well, you got to have the money to put up in the first place. So it all comes down to discipline and temperament. If you really want to make money, not just in the next 6 months or next year, but let's talk about your lifetime and how you want to see your net worth grow over your lifetime. It's pretty clear that sports betting, lottery, buying options, betting on stocks, those are the things that give you the instant gratification. They make you feel like give you action. They get you emotional. Good investing, if you want to make money, put your emotions aside. Do the right prudent thing for you. Have a plan. Come get with an expert, just like you wouldn't represent yourself in court. You don't want to architect your own financial plan because it's complex and it's just wrought with people trying to steer you the wrong way, to try and take more from you than they're providing in value to you.
And as a financial advisor, let's say that they've checked all the boxes and paid off debt and that kind of thing, and they have money that they want to grow.
Mm-hmm.
What do you typically, and I know everyone has different risk portfolio on that, but what are the tools that you use to put the money to grow?
So the first thing that comes to mind is the most obvious thing, which is an index fund. It was invented by Jack Bogle, who founded Vanguard. And the reason Vanguard is massive is because they created the index fund, which in the beginning was dubbed Bogle's Folly. Everybody in the industry hated the idea because it was passive. It was not, hey, I need to hire somebody who knows all what's going to happen in the market and what's the right stock and blah, blah, blah. It's, hey, why don't we just bet on the American economy in general? I mean, we're kind of killing the game here, and I don't want to do all this research to figure out what's the next Amazon or the next Apple. I just want to own America as a whole. I said this last time, you don't search for the needle in the haystack. You just buy the whole haystack because you know if you own American business, you're going to own the next Apple and the next Amazon. And what we've found
and the current Apple and Amazon.
And you own the current Apple and Amazon, which people keep saying, oh, they're going to turn soon. Oh, they're overvalued. And so there's people who say, oh, you can't just buy the S&P 500. 30% of it is 7 stocks. And when those go down, what's going to happen? Well, it's not the first time that there's been concentration at the top. And if you listen to those people 5 years ago, they're screaming just as loud then as they are now. You missed out on the biggest growth opportunities of our generation because those things just kept going up. You don't want to bet against those stocks.
And in the ETFs, you can also own every stock, right? It's not just American company, it's all companies.
Yeah. So, I mean, yeah. So if you really wanted to listen to modern portfolio theory, which I do not subscribe to, even though like that's every advisor goes by modern portfolio theory, they would say, yeah, you need to have some international diversification. You need some international bonds, some international equities, some emerging market stuff. You might need some commodities like gold.
And that's to diversify your portfolio so that no matter what happens, you're always going to be kind of covered in on the uptrend.
Yes, but there's a question as to how much diversification does one really need? And at what point does diversification no longer provide any added benefit? So if you own the S&P 500, that's 500 companies that operate all over the world. One company that comes to mind is Airbnb. I believe they make more money overseas than they do in America. It's close, but I think they might book more overseas in America. So you're already internationally diversified. And if you buy the international stocks, you're buying people who are competing with the American companies. And I don't want to compete against America. I want to be on Team America.
Right. Like Boeing is sending planes all around the world.
Yeah.
Their customers are every country.
Terrible company, terrible stock, terrible company. But yeah, they're still making money, or they're still the go-to.
I never thought of it that way. Like even buying American companies, you're inherently going to diversify throughout the world because they sell products all over the world.
Yeah, people don't understand the scale of American business. We're 25% of the world's GDP with 4.5% of the world's population.
Wow.
So we're making way more than China, way more than India. They each have 1 billion people. We have 300 million, 350 million, and we're just crushing it. 80% of all global trade is done in U.S. dollars. So yeah, people just underestimate the scale of like how much America is dominating the world.
I think California is like bigger than most countries' GDP.
Yeah, it'd be like a top 10 GDP in the world, maybe more, maybe higher. Yeah.
Yeah. So if you so let's walk through it. We explain what index funds are. So people bring you money. Let's just say you went into, they took their money, took 10 grand, 20 grand, 30 grand, put it into index funds. What happens with that money over time?
Well, you can look at history and get a pretty good feel for what will probably happen. If you look at over the last 100 years, we've grown by anywhere from 8 to 12%. The dead number is 9.62% average rate of return. Oh, now it's always changed, but it's somewhere around 9.6% over the last 100 years. That's purely like the index, how much the index has grown. It's investing isn't totally free, so you're not going to make 9.6. You'll make a little bit less probably. Or the market could do 6% over the next 100 years. It could do 12%. But the fact remains that there won't be a better alternative.
Okay, so last time we were on the podcast, we talked about, hey, I have money, but we're at all-time highs, which were all-time highs at the time. And I said, AJ, we got the Ukraine war. We have, I don't know if we even have that clip handy, but we have the Ukraine war. We have all these things that are going on. Rates are super high. Why should I invest now? It seems like it could only go down.
Yeah.
Do you remember what happened from that podcast?
Yeah, that was February 2023. And actually, we weren't at all-time highs. We had come off of an all-time high we hit in January of 22. And then all of 22, the market fell. Just steady, just down and down and down. And so by the time I got here, I think we were down 22% or so. And when the market's down 20%, everyone's super pessimistic. No one's considering it like a sale or a discount or an opportunity. They're all considering it a harbinger of worse things. Like it's only going to get worse, right? No one ever.
Why should I buy now when it's going to go lower?
Why would I buy stocks? They've been dropping all year. Why would you buy that? It's like, well, if it was a house in a neighborhood that you were familiar with, and you were looking at the house and it was 400 grand, and then the next year you're looking and the house is valued at 300 grand, and you look around, it's the same house, nothing crazy happened, it's the same house. You would think that that's a deal, a discount, you'd want to buy that. But when it comes to stocks or the stock market, you don't actually know what it is you're owning, and so you don't have an insight. You can't value it for yourself, so you have to take the opinion of the market or whoever you're listening to on YouTube. It's when people are optimistic about stocks, they're seen as naive, and when people are pessimistic, they're seen as smart. So there's all kinds of the bears, we call them, or perma bears. I think the people, to take your analogy a step further, I think people are saying, okay, I think it's still a nice house, 300, but it might go to 270. I might be able to snatch it up at 270, and they're waiting. Yeah, maybe. But then somebody comes in and buys it for 305, and for the rest of your life, you're kicking yourself because you tried to squeeze an extra 30 grand out of an obviously good opportunity. You got greedy. You couldn't just accept the 100 grand. You needed to get 130, and now somebody else scooped it up.
Okay, and so then you buy those. So what happened? Okay, we were at that number, whatever the market was. If you had placed money into the market when we aired the podcast and you told everyone you need to buy index funds, you need to buy stocks now, I bought some. What happened since then?
So since that day I was here, the market's up 40%. It's down today. Maybe it's 38% now.
40%.
40%.
So if you listen to the podcast and you bought stock, you would be up on average 40%.
Yeah. By the way, when I said that, I came on here boldly standing on my own knowledge.
Yes, and I was a little skeptical.
Expertise, okay? At the same time I'm saying you should be buying stocks, economists were saying there is 100% chance of recession.
Yeah.
Okay?
Yes.
And that's what makes for good prices. People get scared out of it. Another thing we have to understand is time horizon. Different people with different time horizons talking over one another. If the 65-year-old is scared and selling stocks, that doesn't mean the 30-year-old needs to follow suit because he doesn't have time to see the better market. I got 30 years. What am I worried about happening next year?
Well, look, man, you're a bull, and you were like we're down 20%. Maybe that was an easy call because even if you only did 20%, we'd have been break even. Now we're 40% up. We're at all-time highs or damn near all-time highs. Do you still invest?
Statistics say that the best time to put your money in the market is right now.
That's so hard.
It's not about timing the market, Chaz. It's about time in the market. If you want me to guess how much money you made, I ask you, how long have you been invested and how many trades have you made in that time? If you tell me I've been invested 25 years and I made one trade, and that was when I bought the S&P, I know you're making good money. More money than anybody who probably, unless they got lucky, of course, more money than anybody who tried to do something more complicated. You spent 25 years hanging out, playing golf, spending time with your family. Somebody else is jumping in and out of the market every year and paying advisors and incurring taxes, and they didn't do half as well as you did.
So the more successful people are actually the most passive.
Yeah, I mean, there's a reason why all the Vanguard and BlackRock manage 85% of the world's money, because they charge the least. They're passive. It's all about buying the S&P. BlackRock has SPY, and they also own iShares. Vanguard has VOO, which is the #1 fund. So there may not be a lot of people buying them, but there are a lot of dollars going into them.
If I had $10,000, would you recommend that I buy 10,000 of VOO tomorrow, or would you recommend that I buy 1,000 and then next week 1,000 and then the following week or next month drip it in? Do you have an opinion on that?
So there's tons of studies on it, so I don't, it's not about opinion. It's about just the facts of, you can back test this and find which strategy works best. Now, the future is only going to play out one way, and we don't know what that way is. So there's definitely a future where dripping it in was the better idea. But what's more likely is that the market's going to go up over that time. It's always more likely that the market's going to go up.
Depending on the time horizon.
Well, the longer time horizon, if you got 10, 12, 15 years, you got 20 years, it's definitely going to go up. People might think that sounds optimistically naive, but it's based on the fact that humans will keep achieving things. They're not going to stop.